Hello everybody. So in this video, I want to go over 4 consumer brand stocks and tell you which one I like the best. Now, if you follow the channel, you know that the stock I like the best is HIMS. But before I go through each of these stocks, I wanted to take a second to tell you why I invest in consumer brand stocks. Why do I invest in these consumer brands? Why is that a compelling sector? Well, by consumer brands, I mean direct-to-consumer brands. These brands that use multiple channels to reach their consumers, either company-owned stores, but also online channels, and mostly online channels. And I consider this DTC trend to be a mega trend, to be a hyper-growth trend that I want to invest in. And it's an hyper-growth trend because most of the time, the legacy brands can't really do much about that competition, about the direct-to-consumer competition, because they are in an innovator's dilemma position. If you are a legacy brand, let's say you are, for example, a Nike, and you've had your partnership with distributors like Foot Locker, like Walmart, Dick's Sporting Goods. You've had your long-time distributor. If you decide to grow aggressively online, if you decide to grow your own stores aggressively, you're going to make your distributors very hungry. Your old-time, long-time partners in the physical world are going to be very upset at you if you triple down on the online strategy, and therefore a lot of these legacy brands are hesitant to kill the current cash cow for a potentially better business model, which is direct to consumer, which is selling online. This is very similar to what a lot of the legacy car brands are facing with their dealerships, i.e. their physical distributors, and them wanting to sell online and undercut the dealership. Well, if you do that, you may actually lose a lot of cash today in order to prepare for the future. Lots of brands don't want to do that because they are short-sighted. And that is the reason why a lot of new brands can come and disrupt, because they're competing against legacy brands which are using distributors, and this is problematic for them because they have no control on how the product is presented. If they use a distributor, the product is often presented right next to the competition, right next to the competitor. And so if you have a sales guy who's like more into one brand than another, you'll have an underperforming brand, for example, because they like that shoe and they recommend that shoe. So your product is not presented in the best way. You're competing right next to the competitor in a big store, and then you have to give up a lot of that margin to the distributor so that they pay for all of their physical store costs, which is why DTC brands, in my view, do much better. They create much more value for the shareholders and for the consumers. A lot of that saving that does not have to pay for a physical infrastructure, that saving is split up oftentimes between the shareholders and the consumers. And there's tons of brands to pick from, of course, but my view in the space is I want to pick the brand that grows the fastest for the cheapest cost. So for this type of stock, my analysis, enterprise value over revenue growth over gross profit, is a good type of analysis for this type of stock, because really I'm kind of indifferent as to which brand I'm going to choose to invest in. To me, it's all one mega trend, which is these new brands that are coming into the market, and it follows my style of investing very well, which is investing in hyper growth, and I want to invest in at the early sign of product adoption in the case of a brand, right? And I want to get out once everybody owns the brand, right? Once everybody knows the brand, owns the brand, accepts the brand, once a brand is as pervasive as, say, a Nike, that's when I want to get out of the stock. When few people have heard of a brand such as On running shoes, that's when I want to get in the stock. And I'm taking Nike and On as an example because, of course, I cover it as one of the 4 consumer brand stocks that I present now. So let me go back to my slide with the valuation and tell you a little bit about these stocks. So first of all, you'll find that the consumer brand sector, at least what I call the consumer brand sector, has a lot of positive features. First of all, very low value. If you look at the enterprise value over revenue, right, which is kind of a better price to sales ratio, I mean, roughly the price to sales ratio, it's pretty cheap in general on these consumer brand stocks. They are still heavily dismissed by the market. The market still has not picked up on them, and their growth, quite frankly, these are all the to next 12-month analyst number for their growth. Their growth is quite frankly very compelling. If you ask me, if you average it out, you're likely close to a 30%. If you average it out here, their growth is quite compelling actually, and look at how they are all economically profitable. On this channel, I don't use GAAP. I don't believe in GAAP earnings. I believe they are made for 20th century type accounting. But I do believe in actual cash flow type earnings, and EBITDA is the best representation of cash flow type margin, free cash flow margins. And when I use EBITDA, I see that all of these companies are profitable, which is not something you always find in the stocks that I follow on the channel. So another kudos to the consumer brands, and many of them do very well on the rule of 40. So I would call all of these companies economically sound and investable. But another big thing I want to point out, and I'll go for each of these stocks as I show you here, is that most of them haven't run up that much. We haven't seen the runs that we've seen, for example, in crypto in any of these consumer brand stocks, which is why I like them. So let me get started with the first one, and I'm going to go quick because these are stocks that I've covered multiple times on the channel. So On Running Shoes, and let me pull up the chart for On Running Shoes right here. As you can see, it hasn't done much. It hasn't moved much. You're paying roughly the same price that you've been paying for the past 2 years for On Running Shoes. Stock price is roughly flat, yet the company is still growing quite fast. It's growing at 34% next 12 months. What do I like about On Running Shoes? They are very expensive shoes. They're premium shoes, like the shoe that I have in the thumbnail right here. That was almost a $250 shoe, so they're expensive shoes, which is good. That's why you have great margins and you want to be in that segment of the market. They seem to be very popular in big cities, and they have a lot of store-owned stores that do a lot of money in big cities. They have a catalyst coming up for On Running Shoes in the Paris Olympics. They're going to be sponsors there, and they're going to have a major store over there. So they got a lot of things going on. I would argue that On Running Shoes' main competitor is called Hoka. I don't know if you heard about Hoka shoes. That's kind of a competitor for them. But I must say, I live in a big city in Texas myself, and I see more and more people wearing these shoes, and I know it's the same in Europe. So this brand, for some reason, is really resonating with the consumer in healthcare, in kind of, your 40s, 50-year-old dad, mom type buyer. They struck a chord in the market, and that's all I care about. What I love about On is that they have a long-term growth plan. They're headquartered in Switzerland. They have a very unique ownership structure. And of course, this is a stock that beats my threshold, growing at more than 30% revenue growth going forward. Gross margin is great. And the cost, you're not paying that much for that growth at a 0.22. If you're used to my usual spreadsheets, you're not paying a lot on that growth at a 0.22. Tesla is a 1.3, Enphase is a 1.1. So on a growth-adjusted business basis, this is a cheap stock, and the rule of 40 exceeds the 40, right? Which is what you want if you follow this style of investing, rule of 40, which I've grown accustomed to, and I really like to use now when I analyze my stocks. Now, let me move on to another stock, and this other stock that I want to look at is Lovesac. So Lovesac is, again, I pick these stocks not because of a product. I pick these stocks because they're cheap. I'm kind of agnostic when it comes to which consumer brand to invest in. Lovesac is a kind of a recliner type stock. Couch. They do couches, recliners, bean bags. They're competing with, say, the old school lazy boys. That's what they compete in, and they have a reconfigurable couch, and I'm not really qualified to judge the value of the couch. I mean, based on the reviews, it looks really nice, but I don't really care. What I love about Lovesac, though, is two things. A, it is cheap. It is cheaper than HIMS by about a third. So this is one of these stocks that has not run, that is cheaper, much cheaper than HIMS. And it just reached EBITDA profitability. It's been EBITDA profitable Now, the growth, you'll note, analysts are predicting 15% growth for that stock. And the fact that it is this cheap at a 0.08 when we have 15% growth is the furthermore impressive, right? If this is a stock that was growing back at 30%, you get a 0.04, which is something I've never seen on this metric. I've never seen that number ever on this metric. You can probably gauge how cheap this stock is by looking at enterprise value over revenue. It's a 0.7. Their price to sales actually is a 0.5 because this is a company that has a little bit of long-term debt. So again, you're paying roughly half the sales. So I don't understand what Mr. Market is thinking on this one. It is really cheap. Actually, I kind of understand what Mr. Market is thinking on this one. You may have heard that real estate bad because interest rates high. Right now, real estate bad, interest rates high, and if you follow this stock, it's kind of an inverse of the interest rates. Like the interest rates have been really, really high, and so the stock has really, really tanked because, of course, people are never ever gonna buy homes again, and obviously, when it comes to furniture, especially more premium furniture, most of it is sold at household formation. Most of it is sold when people go buy their first house. That's typically when you acquire your furniture. So Mr. Market is very short-sighted, and it's really cut this stock in four. Like the value of this stock is 4 times smaller than what it used to be in June of 2021. Kind of crazy if you ask me, and I think this stock, in my view, will probably bounce back. The problem that I have with Lovesac is that it's such a small market cap, I have not entered a position in Lovesac, although I really want to. I've entered a position in On Holdings, by the way. In On Running Shoes, I've bought my position, and as well as Oddity. I have a small position in Oddity too. But let me move on to the winner. The winner, as you might have guessed from looking at this channel, is HIMS. The winner is HIMS. And let me just note that I've put HIMS as a consumer brand here because, yes, it has the HIMS consumer brand and it's trying to be a healthcare consumer brand. And instead of just being a generic and using the name of a molecule like sildenafil or tadalafil or all of these long molecule names, they will just say, oh, we're HIMS. We're HIMS hard mints. Right, that's what they'll say they are. So they are a consumer brand from that standpoint. I don't want to undermine the fact that I believe HIMS is a much deeper company at its core. I think HIMS at its core is really a disruptor of the pharmacy business, which in and out of itself is a much bigger business than any single consumer brand. It's probably as big as the consumer brand sector on its own. And HIMS is a company that on the back end tries to disrupt doctors, tries to disrupt pharmacies, and even tries to disrupt the insurance industry. The way I define HIMS on this stock is an e-doctor plus an e-pharmacy without insurance. Now, some may think I'm overly bullish on HIMS, but I've done multiple 1 hour long videos on the stock. I've been following this stock for a very long time. I'm kind of one of the odd ones who really believes in the value proposition of this company. Of course, I may be wrong, right? It's all about a risk adjusted. But if you're wrong, and if I'm wrong on HIMS, and if it's actually not the potential well over 10x, like I could potentially see 100x for a stock like HIMS potentially, even if it's not this major disruptor of healthcare. You still got the consumer brand business. It's still a good consumer brand. It's still a great ED company, and it's still a great hair loss company, and they still have a brand going, and they're still direct to consumer. So you still can't remove that from them, which is why I think it fits in this category of a consumer brand stock, even though it's a little reductive for me to place HIMS as a consumer brand. It's kind of like putting Tesla and telling you Tesla is a consumer brand stock because they sell online. A little bit like that. Not quite, but a little bit. So anyways, the stock that I'm very bullish on, we'll see. This is a story, HIMS, that if it becomes consensus, that's going to be a 3-year thing. It's going to be maybe even a 5-year thing. Mr. Market is very slow on these matters, but this is a stock that's heavily sandbagged. They've been sandbagging their guidance. We keep surprising to the upside. Guidance analysts are saying 36%. When I look at what the CEO guided, I am easily calculating 50% revenue growth again over the next 12 months. They need to update their guidance. They haven't done that yet. They need to update their long-term guidance. Their long-term EBITDA margin target is 30%. So this is a stock that could get in the rule of 80 pretty soon, and the market size is just getting bigger. The total addressable market for HIMS is getting bigger and bigger. Of course, the reason why the stock roughly doubled from its lows is likely because of a weight loss product that they've launched. If you follow HIMS, they've launched this weight loss product that's mostly it's a compound-based pharmacy, right? It's a customizable drug that you take for weight loss, but it's mostly based on metformin, which metformin is a leading diabetes drug that happens to have weight loss as a side effect, as well as longevity, if you're curious. But anyways, that's just one side of the offering. That's why the market's a little excited short term. Over the long term, this is a company that has a much bigger potential. I am fairly excited about the other sectors that they're going to get in. For example, diabetes. We know they're going to get into diabetes. That's a leading recurring disease. I mean, sounds bad to say kind of a leading. It's very unfortunate that it's leading, but it's a top disease in the United States, right? From what I understand, about number 2, the second most widespread chronic disease in the US is diabetes. And what if they treat that, right? Treat that cheaper than copay because they just use automated warehouses and custom drugs with, custom molecules that they just spin up in their own, I'm talking about custom. I mean, it's a custom pill. It's a custom pill with a generic molecule, long off patent. They don't do anything patented or branded or very little. This is a business that could get into much, much, much bigger markets. Mental health is another big one that I can think of. I believe this company could grow again to a much, much, much larger size. And I'm very bullish. And I used to be the only one being bullish on this one. And more people are getting behind HIMS. So I'm not alone anymore. Granted, I've been alone, but I'm late. I'm late for being alone. There's people who have been on this stock, namely a good 9 to 12 months before me. I'm thinking about Investor in Innovation, for example. Anyways, point is, love this stock. I think, I'm adding to this stock at these levels, by the way, because we're actually down about 14% from the peaks, and I think $14 for this company is a fair price given the potential. So I'm very happy to keep buying this stock. Now, let me conclude this video with Oddity. So Oddity is an Israeli company in the beauty space. They have 2 brands, one called Spoiled Child, which is for kind of a skin cream, dermatology type cream for women's skin. And then they have makeup, obviously, in a brand called Makiage. And that's what Oddity does. Oddity is kind of taking the custom peel customization of the product, one-to-one product. It's taking that approach to sell cosmetics, and so by that way, they're a disruptor of cosmetics. It pays off. I mean, if you follow Elf, Elf, it's paid off to be the disruptor of a direct-to-consumer brand in the cosmetics world, because cosmetics is all about the distributors still today, and just like you may remember 10 years ago, we had people saying, "Oh, people will never buy clothes online because you can't try them out," and sure enough, so many clothing companies went bankrupt and people just buy their clothes on Amazon today. Well, kind of the same is true for makeup, but makeup is longer lasting. People are saying, "Oh, well, women don't want to buy makeup online. There's no way they ever want to do it because they can't test it, they can't see it." And what Oddity does, it uses AI to scan your face, and then it creates the perfect foundation for you, which is kind of a color you put on the skin to hide moles or things like that. So, anyways, that's what Oddity does. They use AI to create customized makeup for women, and they have a very, very recurring business, actually, just like HIMS, a lot of a recurring business, because once a woman goes through the hassle of creating her perfect skincare product or her perfect foundation product, and she scans her face and goes through all of the hassle, once a woman found her color and the color is a good match, she typically doesn't switch. So it's a long-term thing. It's kind of like a lot of the pills that HIMS sells. Once you found the right pill that works for you, that treats your ED or that makes your hair loss stop, you're not going to change. You're not going to keep that for decades, for the long run. Kind of the same playbook for Oddity. What I love about Oddity, to be honest, I love that it's cheap. That's what I love about Oddity. I think it's too cheap. Can't forget about Health and how that stock ran. Like Oddity could run just like Health. It's still mostly misunderstood company. The name helps. I'm grateful for the name. The name helps making this company very misunderstood. But you see, how much am I paying for that growth on EV over gross profit over revenue growth? It's a 0.16. So that's dirt cheap. That's top 20% cheap in my spreadsheet, and they are the most profitable in this entire spreadsheet with 20% EBITDA margin. So even from that standpoint, rule of 40 is easily blown away because you get 20% more than well above 20% revenue growth. But even if you were to get 20% and 20%, you'd be at a rule of 40. So interesting company. The last thing I'll mention about Oddity is that they want to launch 2 more brands this year, and we don't know much about them, but they're going to be in the beauty space, likely women's beauty space, and they're likely going to use that customization again. So go figure what they could customize. I don't know, is it hair color, for women who do like hair tints, or is it just traditional makeup, or is it lipstick? I don't know. But it's probably going to be something in that space. Very, very profitable space, obviously, and very social media driven company. I like it very much. So these stocks were not investment advice, not financial advice, just entertainment. I'm hoping you were entertained. I appreciate your support. Please like, please subscribe. Thank you for your comments. Thank you for following me on X, and have a wonderful day.